Thank you, Madam Chair, for holding this hearing, and thank you, Chair and Secretary, for appearing before the committee. And like my colleagues, Chairman Powell, congratulations on your renomination for another term. I would acknowledge to you, I'm not sure the President did you a favor, but thank you for being willing to do this again. That said, let's talk about a number of issues, and I'll try and roll through them in some sort of a concise fashion. Since the onset of the pandemic, the United States has added more than $5 trillion to its total national debt, standing at about $29 trillion. And as the Secretary's alluded to, apparently we need to raise the debt ceiling very soon to address that even. And that doesn't count the extra trillions that have gone on the Federal Reserve System's balance sheet. The U.S. is now set to exceed the debt-to-GDP ratio not seen since the end of the Second World War. Chairman Powell, speak to us from a macroeconomic perspective. When's the right time to prioritize the threat of U.S. debt rapidly outpacing economic growth? We've spent a lot of money in the last couple of years.
And, you know, as I generally would say, and as is appropriate, I think, for me to say in my role, the U.S. needs to get back on a sustainable fiscal path. The right time to do that is when the economy is strong, when the taxes are rolling in, when employment is high. And the right way to do it is to have a longer-term plan to get to get the economy growing faster than the debt. By definition, it's unsustainable to have the debt ultimately growing faster than the economy, and we have that now.
Chairman, you and I were both young men in the Carter-Reagan period under your predecessor, Chairman Volcker, when we went through an inflationary cycle that was even more horrendous than this, and the effort that it took to bring that period to a conclusion. I guess I'd like to visit for a moment just about the fundamental issues. Again, not addressing particular legislation, just the fundamental issues. The amount of money through congressional activity that we put into circulation. And in 2020, I think in a bipartisan way, we voted an incredible amount of money out of this place because the wheels were coming off in the spring and summer of 2020 with COVID. And no one wanted to return to a 1929, 1941 period. So we were willing to do whatever it took. But that now brings us to this point of addressing inflation and getting a grip on that. Could you describe how policy, and I know you don't comment on legislation, but how policymakers at the Fed evaluate the results of these kind of forecasts on the economy?
So what we're really looking at is so many things cause inflation, but really it's an imbalance between supply and demand in the real economy. That's what it's about. And you know, we actually see fiscal stimulus, the stimulative aspect of fiscal policy is actually declining and will turn into a headwind next year. You got to distinguish between the change and the level, if you will. So as deficits are coming down overall, you're going to see less in the way of fiscal stimulus to grow off of this high level of growth that we have. We had a very stimulative 2020, if that makes sense.
So the buzz will lead to a hangover, yes.
So, you know, what we're looking at is another strong year next year. Most forecasters see strong growth, but they also see the supply chains getting untangled, and they see the economy, you know, supply side rising to meet strong demand. And we see inflation coming down. Again, it's not a certainty, it's a forecast.
But the balancing act of policymakers, as the supply increases, we still have to address the money that's available to chase those few resources, or this process won't come to an end. Turning to you, Secretary, we've discussed, several of my colleagues have climate-related issues. I am concerned, coming from a district that produces lots of different forms of energy and consumes massive amounts of different forms of energy, that when the majority can't pass a bill to outlaw certain forms of energy, and they can't pass a bill to tax it to death, that the route they're going to take is use regulatory policy to strangle the capital available to those industries. Could you touch on that for a moment? Is it the intention of the regulators to create standards such that banks cannot support any particular energy industry that may ask for capital, that may justify a loan?
Well, as chair of FSOC, I would say our focus is on financial stability, and the regulators like the Federal Reserve are focused on safety and soundness of institutions, and that means making sure they hold adequate capital to
There's a fascinating
manage
report
the
from the New
risk.
York Fed.
It's not
I
a
hope you'll review. With that, I yield back, Madam Chair.